I'm
Yep.
done. And Sean, you take it.
All right, guys. Well, welcome to today's Monday morning mortgage message. Some fun stuff to go over today. I know it's been a rough year with rates being going to the sevens and then dipping back down a little bit, and then had a bad couple days last week. But we have some really good news on a lot of different programs that we have that are very unique. So you might have already heard about us talking about the zero down programs that we have. We have a zero down jumbo that goes up to 1.2 million. We have a zero down conventional loan that goes up to 726,200. Now we have an in-house FHA down payment assistance program to zero down. So we have a second mortgage that we're attaching to it that has two options. One has a 0% option on it. The other one is an amortized payment. And so we have some options there, but it is a true zero down. So I'm going to go over that a little bit today. And that should really help us because it's going to really be, well, the down payment assistance programs that are out right now are terrible. They don't give you very much. If you look on their websites for the different counties, down payment assistance, there's no money in them right now. Let's just call it how it is. So there's only a couple options out of like where we used to have like 10 options on Chenoa and Home 5 and all of these. They're not very good right now. So this one will replace all of them. And guess what, guys? It's national. It's across the whole state. It's not county specific. It's everywhere. We can do it in every state but a couple. And is a true zero down option for FHA. So I'm going to go over that in just a second here. I'm going to go ahead and share my screen and get right into it. So bear with me one moment and we'll go ahead and get started. So let me move this out of the way. A lot of you guys are probably your wheels are turning right now, but it is a true 0% combined loan to value. So if you see this CLTV anywhere, that means combined loan to value. The first is a traditional FHA loan. The second is our in-house DPA program, and that is 3.5% of the purchase price for combined liens of 100% of the financing. We'll go over a lot of those different options, how to use it as well. So there's a forgivable DPA, and then there's a 10-year amortized DPA that we're offering. So the details on that are specific. Depending on your circumstances, you may want to opt for the 0% program because you can qualify for a little bit more. But one of them is forgivable, one of them is not. So we can go over that in a little bit more detail as well. But here's some of the good things about it. The borrower does not have to be a first-time home buyer. So that's key. There's also no income limits. A lot of these down payment assistance programs are limited by your income. So you try to get them and you're like, well, sorry guys, you make too much money. You can't get the free stuff. Well, now you can get it. And so there's no income limits. One of the borrowers has to have go through a home buyer education course that's online. It's super simple. But just one of the borrowers has to go on to that. It is for primary purchases only. You can only buy it for an owner-occupied property. And here's the fun part, guys. The properties that are eligible, and for us peeps up in the Prescott area, we're going to really like this because manufactured homes, double wides, are available on this program. So condos are eligible as well if it's an FHA-approved condo with no litigation. You can also do a 2-unit property. That's right, you can do a 2-unit property. And then obviously single family homes and homes with HOAs, which is a PUD, planned unit development, those are eligible as well. So some exciting stuff here as far as the property types that this is eligible for. And because I know this is a big need for a lot of our buyers in the Prescott area and surrounding areas of Maricopa County and that have manufactured homes. So here's even better. Look at this, down to 600 credit score, guys. Whoop, down to 600 credit score. Now, will your rate be better if you have a 700 credit score? Absolutely. But your buyer can have a 600 credit score and still qualify for this program. It's a fantastic loan, but it does follow FHA limits. So it's just a normal FHA loan. We just tag on a second mortgage and in-house that DPA for you. And it's going to follow normal FHA guidelines. Another thing is, there's non-occupant co-borrowers that are allowed. So if my son wants to get this, I can help him and we can do a zero down purchase and I can co-sign for him. The same is true for your customers as well. They have to be family members, but a non-occupant co-borrower is allowed on this program. So, I mean, the possibilities are endless for parents helping their kids, for family members. It doesn't really matter as long as they're family, but they can jump in and help on this program to qualify. And again, income is the key to qualifying. So if you don't have enough income, you can have some family member jump in and help. So that's the program. It's brand new, guys. It's rolled out on Friday. So we're going to have flyers. We're going to have a lot of different program items for you to share as far as social media. We're going to have a lot of stuff for you guys to send out to your customers. But I'm going to take some questions because I'm sure you guys have some questions. So in the chat, do you have any questions regarding this program? The 3.5% can be used to pay for down payment and closing costs. Obviously, if you can use it for either or, it doesn't really matter because it's money as well. But here's the cool thing. You can have this pay for all of your down payment, and then you can have the sellers pay all your closing costs. So you could literally walk into the home with nothing out of pocket. Now, depending on your rate, your credit score will depend on your rate and how much yield spread is in there. That's the how much money we can use for helping paying closing costs as well. But there's a way of doing these with 0 points. And I know a lot of the down payment assistance programs that we've had in the future, they're expensive. There's a lot of fees involved. There's points involved. So you don't, if it was a 3% grant or a 3% down payment, you may only get 1.5% after all is said and done with all of the fees. This one is not like that. So this should open the door for quite a few of your customers to take advantage of this zero down opportunity. Less restrictions. It's wide open. It's all over the state, all over the country. So it's pretty good. Any questions, guys? I know your wheels are turning. You're probably thinking, oh, well, this customer that I talked to 6 months ago may really want to use this program. And so dust off those old files that maybe they didn't have enough to qualify, or they needed closing costs and that there's no way of getting the sellers to pay closing costs in the market they were in. Who knows? So look at those scenarios and we can talk about how we can get those people back into homes. Any questions on this program, guys? Now, it follows standard FHA rules. So desktop underwriting, one of the biggest problems that we had with the down payment assistance programs is the debt to income ratios were capped. They were limited. You can only go up to like 43 or 45 back end ratio with an FHA loan. This one doesn't have those caps. So you can go all the way to whatever the DU, whatever automated underwriting approves, we can do. That's one of the biggest changes here. So I know that you guys have seen, we can pre-qualify them up to this with a traditional loan, but on DPA, it's like 75,000 less because the qualifying terms are a lot more strict. With this, it just follows DU, which is desktop underwriter, which is the automated underwriting engine. And depending on their risk, they may be able to go up to 55 DTI, which is high for a down payment assistance program. So that's the program. We're going to have lots of questions. And if there are no questions, you guys go ahead and jump into the chat if you have questions. But we're going to go into now rates. What are rates doing, guys? I'm going to share with you kind of what the bond market's doing, and because it's been interesting. Today over the weekend, we had Saudi Arabia tell us that they are going to be lowering or cutting the amount of oil that they're going to be manufacturing, which is never a good thing for, hold on, let me get rid of this thing here. Never a good thing for inflation, because if they lower the cost of oil, then, if they lower the cost of oil, then inflation goes down and mortgage rates get better. If they lower the production, that increases the cost of oil, which hurts inflation. So this is a bad thing. As you can tell, the bond market is down 22 basis points because of that. But look at the volatility. This is at opening. We were down 35 basis points to start, and then we were positive. Rates are trying to stay, and then we're negative again, and then we were positive, and then we were negative, and then we're positive. It's a bipolar day. So we're trying to really hard to stay out of trouble with mortgage rates. And I'll show you what we've done the last week. This was 2 weeks ago. This was just the constant drip downwards. The mortgage-backed securities lost their shorts. The whole debt crisis, the debt ceiling talks, it was not looking good. They thought there'd be trillions more spending, so that would make bonds worth less, which makes them value drop, which makes mortgage rates go up. But then we saw a little bit of a reprieve, and we saw a big rebound here. I locked quite a few loans last week right up here, but then we opened it up to get above. If we can stay above here, we're carefully floating right now for any new loans that are coming in, because with the new inflation numbers that are going to be coming out,